Warren Buffett is the greatest investor of our time with returns over 20% from 1965 to 2024 in all sorts of different industries. One of the easiest things to spot in his long career is that the easiest way to build a fortune is by building a quality business. If you want to succeed as a business owner, then there are definitely some things you have to learn from the man who has been better at picking high-quality, successful companies than anyone else. My name is Grady Cool, CEO of Cool Wealth Management. I've read just about everything Warren Buffett has ever produced or written, including the 50 years worth of shareholder letters he has written for Berkshire Hathaway, the company he turned into a $1 trillion company. Let's go through what I've learned about how to build wealth as a business owner and how to build a successful company based on everything I've read based on Warren Buffett and what he uses to pick investments. If you're going to start a business, then you need a clear competitive advantage. There needs to be a reason that someone is going to pick your business over somebody else. For myself, I position my competitive advantage with Cool Wealth Management as ethics and personalization. Finance companies have developed a terrible reputation over the years for screwing their customers, and I pride myself on being able to put my customers first. When it comes to personalization, I have both a CFA and a CFP, giving me a much deeper education than almost 99% of advisors out there, meaning I can find alternative options for clients whenever they have different preferences. You're going to have to pick what it is that really makes you and your business special and then really focus on that. The most notorious example of this that Warren Buffett always goes back to is Coca-Cola. Their brand value, which, yes, after 50 plus years of advertising, is a competitive advantage, has made it so that there are places on Earth where it's easier to find a Coke than it is a clean glass of water. The reason a competitive advantage is so important is that it provides focus and a clear message. If you sell mops, and they're no different than the mops sold over at Walmart, then people are probably going to pick the mega conglomerate Walmart because 1, it's probably cheaper, 2, they trust the brand, and 3, if it breaks, they can probably get their money back. Now, if you sell mops that last for 50 years and they're much more comfortable to use, then someone might actually pick you over Walmart. A strong competitive advantage that is focused on at all levels of the company is a good indication of quality management. The second big takeaway I've had from Buffett on what makes a strong company is strong management. When investing in massive companies, this is a little bit easier to see with the likes of Tim Cook with Apple. Steve Jobs had some great innovations with the iPhone, don't get me wrong. But Tim Cook is who took Apple from being a cool tech company to one of the top 5 biggest companies on the planet through quality operations.
What the heck does that have to do with me?
As a small business owner, quality management is you. How smoothly the company operates and grows is all on you. There are a lot of different opinions about how to run a company, but ultimately there are a few key details that really help bolster the bottom line and keep clean operations. A lot of it boils down to little things. Are you paying your bills on time? Are you paying a reasonable rate for the necessities? Insurance, rent, office supplies, software, etc. Are products or services being delivered to clients in a timely manner? When a client has an issue, are you responding within a timely manner? It all comes back to the little details, but those things do add up. And yes, it all does start at the top with management. That is you, baby. While I would love to say that that covers it, we still need to consider consistency. One of the big things that Buffett preached was investing in companies that have predictable and consistent earnings. When you're investing, it makes it a lot easier to know what you can roughly expect from the company moving forward. It's a lot harder to make quality decisions when earnings are catapulting in different directions constantly. Earnings tend to be a byproduct of the business. If earnings are consistent, it usually means the systems within the business are consistent as well. Consistency is needed to identify trends and to start to build better systems and processes. The business made up of systems can slowly be adjusted over time. If I make changes every 2 weeks, it's hard to really know what's going on. I don't have enough data to make accurate inferences or make good decisions. If I'm going to try something new, like running 50% more ads, then I need to give it a few months to see how it does. Earnings should be more predictable from this as well. If you're going to make changes to the business, then focus on the ones that are the most impactful and then give them the support and time needed to be able to breathe and really see them come to life. Eventually, if you keep making changes to the company's most important aspects, you should start to see a growth in earnings. Making changes like that is a lot easier on a business that has high returns on investment. Buffett loved companies that had high returns without borrowing tons of debt. His idea was that it makes it easier for a company to reinvest back into the business, thus compounding returns even further. With plenty of cash around, it gives you plenty of flexibility to make those changes in the areas where it is most impactful. As we talked about before, those changes are ultimately what a company needs in order to be able to have sustainable growth. Buffett preferred the term return on capital instead of return on investment, meaning the money that the company actually reinvested on the balance sheet. Companies with a high return on capital are generally a byproduct of businesses with a high margin. The most common example of this is a software company like Microsoft. They create a piece of software with some investment up front. Their most common one that they sell is Windows operating system. Now, they sell it for over $100 a pop. Doesn't sound like a ton, but when you sell it to billions of people, and there's very, very minimal cost for each person you sell it to after that, you get much higher margins. While we do need to consider the investment up front, Microsoft still has margins above 30%. Comparing 30% to the average stock market return of 10%, I would say they're doing pretty well. If you're picking a business model, a product or service that has high margins should make it easier to have a business with high returns on investment, which leads me to my last point. Buffett absolutely loved simple companies that anybody could understand. He would settle for companies that he could understand, but he really would love a company that he could explain to a 5-year-old very simply. In our day and age of AI and internet companies, it feels like everyone wants to build an app or some complicated business that nobody really understands. That strategy works great for scammers that are trying to take advantage of old people and simpletons, but that's not really what we're going for here. If you can't explain it to people, it makes it, 1, easier to make mistakes, and 2, makes it much harder to get buy-in from reasonable people who are generally better customers. Look, I'm not saying that you have to sell buckets just because that's something that you could actually explain to somebody. That would make a competitive advantage fairly tricky. What I am saying is that you want to sell a product or service that the person purchasing it actually knows what they're buying. That being said, how you explain can make a big difference. For example, I could explain what I do with my wealth management company with something along the lines of, I help people get what they want out of life using money as a tool. But generally speaking, they look at me like I just pulled a physics book out of my butt and asked them to explain, how does quantum mechanics work? Now, if I was to take the time to explain a little bit more simpler words, I help people get rich, they tend to understand a little better. While I find that a dramatic oversimplification, sometimes that's what you have to do to sell a product or service. If you can't make it that simple, then you may have an issue. Now, bringing it all back together, we want a product or service that is simple enough that we could explain it to a 5-year-old and be able to have a high profit margin that leads to high returns on investment by reinvesting the money we get from the high profits back into the business, causing sustainable growth over a long period, all supported by quality management. That's a lot to ask. You don't need to get everything perfect. Every business model has its issues. Just try and get the most out of this advice that you can. I hope you guys enjoyed, and other than that, I will see you in the next one. Bye.